Here we are with clip 6, chapter 5, clip 6. We have clip 6 and then clip 7, and we're done with chapter 5. So let's go ahead and talk about 3 more types of institutional investors, and we'll start with endowment funds. All right, so endowment funds receive contributions, and then they fund projects such as raises for college professors. Boy, that sounds like a wonderful project to me. Or scholarships for students. I bet that sounds like a wonderful project to you. Or building projects. It's nice to have a good classroom and a nice office, but I'd rather have lower tuition or higher raises. All right, that's just my personal preference. Anyway, so there's often a conflict between the ongoing income uses, okay, the raises for the professors or the reduction in tuition for students, and future uses that require capital appreciation, like saving for a new building. Okay, so conflicts. How do you manage a portfolio? If you're in the financial services business, let me just give you a bit of a caution. If you go into the financial services business, be careful about joining boards of nonprofits for the purpose of business development. In other words, I think it's a conflict of interest for you to go onto the board of a charitable organization in order for you to try to pick up the portfolio at that charitable organization. Now, if you want to network for the purpose of picking up business away from that charity, that's one thing. But I would say to you, I've seen it done in practice, and I think it's a terrible conflict of interest to join a board of an organization that has a portfolio in the hopes that you'll get that portfolio. I think you either manage the portfolio and stay off the board, or try to get on the board but not to manage the portfolio. Okay? That's just my personal opinion. All right, now let's look at insurance companies. So what do insurance companies do? They collect premiums from customers, clients. They invest those premiums, and they're supposed to pay out claims. Okay? So investment returns are very important to insurance companies, the returns they make on the premiums that they invest, and also the underwriting success. And underwriting has to do with pricing insurance properly, and also assessing the risk that the insurance company is taking on when they sell insurance. Okay? The investments made by insurance companies are regulated by the government because the insurance companies have to have the money available to pay claims. Okay? So insurance companies must balance the desire for returns and the need for liquidity to cover claims. So we're talking about institutional investors, we're talking about organizations that need to invest money. Okay, lastly, let's look at banks. What do banks do? They take in deposits, people take their money to the banks, and then the banks use those deposits to fund loans and investments. And let's be clear about this. When a bank makes a loan, that is an investment for the bank. That loan is an investment, okay? So the keys are to earn an adequate spread between the cost of the deposits. This is the interest rate that the banks pay to depositors on checking accounts and savings accounts and CDs, and the returns that are earned on the deposits, okay? So banks must carefully manage loans and investments to maintain adequate liquidity to meet withdrawals by depositors, and there are regulations that require a certain amount of liquidity, and to maintain adequate capital to support the bank's ability to stay in business. So banks have to meet regulations, and they have to earn adequate returns, and they have to meet liquidity needs. So there's a lot of balancing that goes on. There's a lot of work that goes into managing bank portfolios. Okay, so we're at clip 41. All right, so we've got a long way to go. Excellent. So let's move on with the portfolio management process. And believe it or not, we started with having a written investment policy statement. That was the first step, a written investment policy statement, way back when. So we start with A, the written investment policy statement. Now we have B, assess the current economic, political, and financial market conditions and project where we think things are going over the near term, and we fine-tune our asset allocation. Okay? So when we're fine-tuning an asset allocation, we have to decide which asset classes should be included in the portfolio. And these include things like stocks, bonds, cash, which means like a money market fund, precious metals, real estate, global securities. These are all asset classes that should be included in the portfolio. Okay? And again, some investment managers are able to access and manage all of these asset classes, and some just focus on certain of these asset classes, and some just focus on subsegments within these asset classes. Okay? So if you have an investment manager that specializes in small cap U.S. growth stocks, that is just one sector of the stock market. So within each of these asset classes, there are several sectors. Do you want gold? Do you want silver? Do you want palladium? Okay. Do you want government bonds? Do you want junk corporate bonds? Do you want 30-year bonds? Do you want one-year bills? Okay. Do you want U.S. stocks, domestic or foreign stocks? Do you want large cap stocks, mid cap stocks, small stocks? Do you want international stocks, developed international stocks, or emerging stocks? Do you want value stocks? Do you want growth stocks? So there's a lot of work that goes into each of these areas. Okay? All right, so based on investor risk tolerance, investor objectives, investor constraints, and the attributes of the various asset classes, like risk, return, and correlation, valuation, intermediate term historical performance, all of these things you look at, okay? You establish a range of percentages of total funds that should be allocated to each asset class. Let's take a look. For example, for an aggressive investor, the asset allocation may be 60 to 80% in stocks and 20 to 40% in bonds. Okay, now that's a two-class allocation, just stocks and bonds. Now again, within the 60 to 80% stocks, you got to go into all those areas that I just rattled off a minute ago, and the same thing in bonds. And notice that commodities are nowhere to be found in here, metals nowhere to be found in here, real estate nowhere to be found in here, okay? So that's a simple example. Now please, this is an important point, please note. Oh, you know what? We went too far. So let's stop there. We went one slide too far. No, we didn't. No, we didn't. Let's continue on. No, we didn't. We're good. We're going all the way. We went 38, 39 through 47. So let's continue on. All right. Good investment managers may add some marginal investment returns. How many managers add alpha? Remember I mentioned alpha as compared with the beta. Beta measures the relationship between the return of a stock and the return of the market. Beta measures volatility. Alpha measures return, actual return that is earned above what the capital asset pricing model suggested the return would be based on your beta. So let's say your capital asset pricing model suggests that you will earn a return of 10% in stock, and you actually earn 14% in that stock. You have just generated alpha. That is the question. Will good investment managers add marginal investment returns? That's alpha. And I'm sorry to say that the vast majority of managers do not deliver alpha. They may deliver beta, but they don't deliver alpha. And if they do deliver alpha once, they never do it again. Okay? No one consistently delivers alpha. All right? But 85 to 95% of total returns on a portfolio are not due to picking good stocks. They're due to your asset allocation. All right? So by combining different asset classes, you might give up a little return, not much, but you significantly lower portfolio risk. And we'll talk about this diversification, the benefits of diversification, the mechanics of it, how it works. We'll talk about this in more detail. You know that over time, stocks provide higher returns and higher income growth. Dividends grow, while generally, if a company is successful, they'll increase their dividends, whereas bond interest payments do not grow. Okay? So here's the general rule. take the number 110, then subtract the investor's age. And what you get is the amount that you should allocate to equity in a portfolio. It's a very, very simple rule of thumb. Here's an example. You have a 35-year-old person. You take 110 minus 35, 75% of that person's allocation should be into stocks. That is a very general way to look at it. And of course, we've talked about more details about how to get asset allocation. All right, so written investment policy, fine-tune the asset allocation. Then we implement the plan by selecting individual securities. Okay? As you select individual securities, please keep in mind that the risk must be considered in the context of the entire portfolio, not on a security by security basis. Okay? Individual securities should be selected based on their investment attractiveness and based on their particular exposure or correlation that they bring to the portfolio. Okay? That's judging an individual security. However, and if you're going to judge risk for a client, you have to judge it in the context of the portfolio. In other words, you might have an 80-year-old who has 30% in stocks, and you might put 1% of the portfolio into a risky stock, and that would not be unsuitable in the context of the overall portfolio. Okay? Then you measure and communicate portfolio performance. Okay? So written investment policy, and then fine-tune the asset allocation, implement the plan by selecting individual securities, measure and communicate portfolio performance. Okay? Performance evaluation should include the manager's adherence to the investment policy statement. Returns should be put into context by comparing them to a pertinent benchmark portfolio. Okay? Picking an appropriate benchmark is important. The benchmark portfolio should reflect the risks and the types of securities specified by the investment policy statement. We've talked about that already. For example, if a manager is told to invest in blue chip stocks, the S&P 500 index would be a relevant benchmark. If, however, he or she has a mandate to invest in small company stocks, the Russell 2000 index would be a better benchmark. Okay. All right. Then you monitor investor needs and changes. Okay? You monitor financial market conditions. You monitor your individual securities for things like valuation, management changes, competition, the size of the position. You look at all these things, okay? And you make necessary portfolio adjustments. It is a loop, folks, okay? Changes in age, employment, dependence often change the risk, return, and liquidity needs of clients. We talked about all these things. Changes in asset prices and values spur portfolio adjustments as well. So you can have changes in the securities, changes in the financial markets, or changes within your clients' lives that will prompt you to change the portfolio. All right, so here's the summary of the portfolio management process. You have the written investment policy statement, you have risk and return objectives, liquidity needs, asset allocation. Assess the current environment and fine-tune the asset allocation. Select individual investments, evaluate and communicate portfolio results, monitor investor needs and financial market conditions, and make portfolio adjustments. So these are the 5 steps in the portfolio management process. It's a continuous looping process, and yes, you will be held accountable to know this information for the exam. And we've reached the end of this clip. Let's move on to the last clip. Clip 7, which is slides 48 through 52. Let me take a deep breath. Shalom.